Hello everyone, welcome back. Here is Ali Talabi, and this is the second lesson from Module 16, Economic Industry Analysis. So in this lesson, we're going to talk more about the economy, and specifically we'll talk about inflation and monetary fiscal policies. And also, as I promised, we'll talk about the industry analysis and also industry life cycle. So let's start our session. One of the major economic factors which impact on your investment is called inflation. What is inflation? Inflation is determined by CPI or Consumer Price Index. The CPI is actually using the average price of a fixed basket of goods and services. So every year you can trace the CPI. So you can find the CPI changes, and that changes is actually the inflation. So for example, if the CPI was 100 unit and now the CPI is 110 unit, it means the inflation is 10%. So it's going up by 10%. Why this kind of inflation is important to us? Because it can reduce your real rate or your real return on investment. So as we have higher inflation, it means the actual return of our investment will be lower. So in other words, there is a inverse relationship between the inflation and the real GDP. We learned the previous lesson that the GDP is very important to us. However, I mentioned that it's better to include the real GDP in our calculation. What's the real GDP? Real GDP is taking out the impact of inflation from the nominal GDP. And remember, there is a negative correlation between the inflation and economic growth. And remember that as the economy becoming smaller because there is a higher inflation, it means that the value of your investment is going down. So you might end up having lower actual return. And again, remember there is a negative relationship between the inflation and the stock prices. There is a rule of thumb you can use to see the connection between the inflation and the stock price. Usually, we are saying the inflation rate plus the market price to earnings ratio should be around 20. So which means if the inflation rate, for example, let's say is 10%, the market price to earnings ratio should be around 10. If the inflation goes down to 5%, you expect the price earnings ratio goes up to 15. So in other words, higher inflation, lower PE, lower inflation, higher price earnings ratio. So that's how inflation can change our return of our investment. So governments are following different policies to manage the money which is available in the market. So there are two major policies. One is called monetary policies, and the other is fiscal policy. The monetary policies actually is based on the changes in the money supply. So as I mentioned, the governments, they change the level of the money by using these policies. So there is a positive relationship between the money supply growth and the stock prices. So as the money supply growth is increasing, you should expect higher stock prices. However, remember, it also creates or generates higher inflation, which, as we argued, it might reduce your real actual return. So you have to be careful that when I'm saying the supply, the money supply will increase the stock price, I mean the nominal price, which means the nominal return. Now, what's the impact on your real rate? You have to calculate the inflation, and you have to take out or remove the impact of inflation. Another policy which governments they apply, they use, which has usually longer term impact is fiscal policy. The major difference between monetary and fiscal is the monetary policy usually have the short-term impact, however, and quick impact, instant impact. The fiscal policies usually have the longer term impact, so they can stay for a longer term. And for sure, it takes a longer time to see the implication of fiscal policies. The fiscal policy is highly dependent on the level of tax rate and spending. So G, government spending, and T, tax rates are two major factors which determine the fiscal policy. And remember, fiscal policies, they have significant impact on the overall economy. But as I mentioned, the impact is a bit slower, but deeper and in a longer term. Now, let's talk a bit more about industry. Let's assume we come to the point that it's a good time to invest based on the macroeconomic factors. So you have several options when it comes to industry. And don't forget that you have to be careful that some industries are cyclical, some industries are more defensive. So depending on the economic situation, you might choose different industry. Based on the S&P's classification, there are 11 major sectors in the market. As you see, they're listed here. And the sensitivity of these sectors into the economic factors are different. The growth rates are different. For example, let's look at something which is called heat map. So here is an S&P 500 heat map. What is the heat map? Heat map provides a visual snapshot of the market and sectors. Now, within each sector, the heat map identifies the specific companies in S&P 500. For example, technology sector, as you see, for the last year, the Microsoft has been performing well. So the stock price of Microsoft has been up by over 40%, or Apple has been up by over 77%. The size of each box represents the relative market weights. So which means the market value of that company to the whole market value of other companies. Now, each box is color coded to identify whether the stock price for the particular company, and for sure the industry, has been up or down. So green means up, red it means down. So this provides a snapshot, a screenshot of the whole market. So this is for the last year, November 2019 to November 22. And for sure, you can go for the different frequency of time and look at different sectors and different companies. Now, you can also look at different sectors based on the growth. Here is showing the 1-year performance of the S&P sector. So we talk about 11 sectors which you can find based on the S&P 500 classification. We're talking about the same economy, same macroeconomic factors. However, each sector has its own unique performance. For example, here, the information technology, which is the brown one, has the best performance. So for the last year, the stock price has been up by over 39% in this sector. However, in the same sector, you will see that the energy sector and the firms with the energy sector hasn't been performing well. So the total market value of the stocks in this sector has been down by almost 40%. So similar to economy, which we talk about the business cycle, we have similar cycles within each industry, so which is called industry life cycle. So different industries are in different stage of their life cycle. So we have 4 stages, as you see, with different specific features. So starting from the startup stage, which the growth is very rapid and the sales is going up remarkably, up to the relative decline, in which the growth is minimal or even negative. Why is going to be important to us as an investor? Remember, when you know that industry is in what stage of its life cycle, so it helps you to identify which companies are expected to have higher growth, which companies are expected to have lower growth, given the industry they are falling into. So that's kind of important to understand the company you are investing and the sector or industry the company is actually working on. It helps you to understand the life cycle and you can expect regarding the growth of the company. That's it for today. Thank you very much. In the next session, we'll come back with some hints, some notes, and some questions to review. Till then, have a wonderful day. Talk to you soon. Here is Al Talabi. See you soon.